Just a short introduction of myself. My name is Richard. I'm a partner in the corporate practice group in RHD Taylor Wessing, a full-service law firm in Singapore. And I'm the moderator for this panel, as introduced earlier, for the very interesting topic of a fine line between venture capital and private equity. Without further ado, I would like to take this opportunity to let our esteemed panelists give a short presentation on themselves as well as the work that they do in their respective businesses. Maybe I'll invite Amit, the Managing Director of Alp Invest Partners, to introduce himself and Alp Invest Partners.
Thanks, Richard. Hello, everyone. My name is Amit Sachdeva. I'm a Managing Director with Alp Invest Partners, which, as some of you may already know, is an LP in the private equity world, predominantly doing fund investments, co-investments, and secondaries. We have been doing this for almost 2 decades. We've been doing this for about 2 decades now. We have a global program. We have deployed about $65 billion, more than 650 fund commitments, more than 250 co-investments, and more than 130 secondaries. I'm based in Hong Kong, and I lead their co-investments practice in Asia.
Thanks, Amit. Thanks, Richard. It's an honor to be here. My name is Dennis Kwan, Managing Director and Head of Asia for Envision. Envision is a global placement agent based in Hong Kong. We also have offices in London and New York. Basically, for some of you that doesn't know us too well, placement agent is the intermediary parties that help connect the LP capital to the GP's funds. So we are, helping the GP to fundraise for their funds. We have been around since 2001, so around 18 years of history. Thanks.
Good afternoon. My name is Hui Sing, and I'm from TVN Capital. We are a healthcare dedicated sector investment group. We do both VC and PE in separate teams and separate funds. And we cover from North America, Europe, and emerging markets on the different parts of that spectrum. So we're really interested to talk about this topic because it spans the kind of the spectrum of the activity and investments in private markets that we do. Thank you.
Vincent Chen. Some know we also do both VC and PE. We cover about 10% of our 800 million fund to invest in Series B venture. The remaining 90% is still do the buy and build. We identify the key promoters in Asia and India, and then we will basically build on A and B round. So we do buy and build as a core business, and then 10% in VC in India and Asia.
Thank you, Amit, Dennis, Hui Shin, and Vincent. Now, to get the ball rolling, traditionally, there were clear and distinguishing factors between private equity and venture capital, such that private equity traditionally invests in mature companies and venture capital tended to invest in early stage companies. Amit, I understand that you have some thoughts on this, on the emergence of venture capital and private equity. Could I have your perspective on this?
Sure. I guess that's the reason why we're all here today, because obviously over the last few years we have seen a lot more enthusiasm, a lot more interest in the VC asset class. And as we have seen over the last decade or so, VC investments have definitely gained a lot of momentum. Just to put things in perspective, I think over the last 5 years, VC used to be about 11% of the overall PE activity, and today stands about 30. So there is definitely a lot of interest, a lot of capital being raised. I think last year we raised more than $250 billion just for this asset class globally. So definitely there is a growing trend towards VC investments, and the lines are getting blurred we do see the emergence of managers which are looking to, traditionally were doing, as you rightly said, more sort of private equity kind of investments, but now moving into a space which was traditionally owned by VC-specific managers. So the lines are getting blurred, but I think there is definitely still a case to be made where we believe that there is specific skill sets that are required for each of those asset classes, and I'm sure we'll talk about that as we progress. But the one thing that I would like to highlight is that a lot of the returns that we see in the VC, which is generating the interest, is obviously spectacular, but it's clustered in very few investments. I think over the last 10 years, less than 10% of the overall investments made in VC have been exited, and less than 1% of those are accounting for more than 80% of the return. So something to keep in mind as investors are looking to diversify into VC, think about whether they should look into PE or VC asset.
Hello. So yeah, I would agree to admit, sitting where we are when we talk to LPs every day and we look at, and we see a lot of GPs, I think in Asia in particular, this is, VC is here to stay. And, when we look at a lot of the VC funds, their numbers are actually quite good. When we look at it, it's like 3 times, 3.5 times on the book. But one thing that we notice is when you start to dig inside of the portfolio, there aren't that many distribution for the LPs. So the question is, the valuation can keep going up until it exits, but when's the exit going to come? And that's the top of mind for a lot of LPs. So on the flip side, meaning, LPs are looking for perhaps more DPIs-driven investments. So are they going to move back to potentially more a traditional PE where, companies are more mature and there's sort of a stable exit path, etc. So that's what we're seeing right now in the market, where there are two forces trying to pull, on a different directions.
So a couple of comments. First on macro. I think one of the reasons why this line is getting confused is the players in the VC space are proliferating. So you have the traditional independent fund manager VCs, and that's what our VC team and TVM is. But what we've seen increasingly is the entrance of other people who claim to be in the VC space, like strategic corporate ventures. They call themselves corporate VCs. We've also seen sovereign wealth funds, including our local Temasek, playing in the VC side. And a whole slew of others. And I was interested to find out that there was even a class called VC buyouts who came in. And, so I think when we talk about VC now from a nomenclature point of view, it's also getting quite broad, and we're seeing the entrance of many different people in that. And so when you have, startup unicorns, raising billions of dollars in VC rounds, this is the reason why everyone gets confused as to who's a VC and who's a PE. And you see both kind of players entering that kind of round, because the rounds are large, and so they defy all the traditional definitions of parameters and boundaries. So having made that point, I just want to talk about, from TVM Capital's point of view, we started live as a VC, where we looked at biotech venture capital. And to us, we define where our VC colleagues play and where our PE colleagues play. So it really revolves around still technology risk. It's no longer about the size of the round. It's no longer about whether it's early or late stage, because business models are getting hybridized. You have ongoing revenue stream businesses together with early stage technology platform. So for us, it's whether the investment that we're looking at has a higher technology risk component, and whether the funding that we're putting in is to bring it to proof of concept of that technology. And if it is, we will consider this a VC investment, and our VC side will take it, because that is our exit point. Once we fund it to a proof of concept of the technology, that's the exit point for us. And then on the PE side, we don't take this risk. We look at proven technology, and we will work on that in many ways. It could be greenfield, it could be a startup. So the staging is no longer relevant for us. And yeah, so I think I'll stop here for now.
I think from my side it's just to share 3 experiences. I joined the industry in 91 with HSBC Private Equity. I think they are basically winding down after Fund 6 for whatever reasons. But that is a reflection about, before 97, I think there was not many VC either in Singapore, Walden. So most of the guys like me, the 3rd, 4th generation in the private equity side, we went through the first phase is really in private equity. But most of them are not performing for whatever reasons. Palmer gone, Transnet has gone, HSBC has gone, and another firm, Sue, is also gone. Those are the big ones. So either the return is not there, that model didn't work. Second point is about when I learned from one of the other conference organizers, there are 3 guys on the stage. I was listening how they be successful. One is Affinity, it's all do buyout, but they also do some technology. One is Warburg Pincus, and one is Baron. Baron, I think Sean will tell you, they are only doing buyout. They use it as a VC growth, but they are no longer doing growth, they're doing buyout. So Barron's is proven, they're only doing buyout. I think Dennis knows the return better than myself. Affinity, I think they do both. They also have a favor about technology and they make good money. Warburg Pincus, they have done 200 million plus in both late-stage technology investment. They have very good track record, which someone I do admire. I think lastly is PAG, actually, I forgot. PAG is everything. But some of the best return is the Tencent Music and all this. They make many times of money. That is also from an outsider is very impressive. So I think lastly about me as Sanmina, a small firm, how we have evolved. We start as the other part of our facing is we start with growth investment, but over time we also change because the world has changed. We also allow, including myself, encourage the founders to allow younger partners to invest in technology investment. What we cover 10% doing Series B. I think in Southeast Asia we done Happy Fresh. We become the single largest shareholders of Happy Fresh. We own 28% of the company. And then in Middle East, we've done the Spotify equivalent of Agami, which is a digital streaming company. We are the 2nd largest shareholders. But this is just a learning. Whether we like it or not, the market has changed. And even for traditional growth investment, we invest in companies starting from basic. But now we did a medical group like Fullerton in equivalent in Great Bay Area. In day 1, we make about $10 million US EBITDA because it's aggregation. So it's whether it's VC or growth is irrelevant because the basic thing is when things are getting expensive, you have to change your investment strategies. In front of LP, you say everything about discipline, but in the real life, the world has changed. The landscape has changed. And how much money you can deploy and able to create an edge for you to continue to make money, I think is the key.
Thank you. Dennis, quite interestingly, just now you just mentioned from Envision does as a placement agent. I'm sure as a placement agent, you see a lot of funds, both PE and VC. Perhaps you can share your insights as to what would make a very successful product and what in your years of experience your gut feeling tells you it's not going to succeed, and years down the road, it proves itself. Dennis?
Right. That's a very good question, and I wish I know the answer. Because if I do, then all the clients that we work with will be very successful, and they can raise multi-billion funds out there. But I think in practice, there are a lot of components to become a very successful fundraise. Obviously it's tougher for first-time managers, but usually right place, right time, etc. That's very important. One thing that we realized is, when a GP comes to us and told us that, I have this fantastic idea, which will make us 5 times money for sure, and I should be able to raise, 1 billion very easily because this is a no-brainer. I'll tell you 100% of the time, this particular GP is wrong, and we can't even raise a single penny. I think what GP needs to know is listen to the market, try to fill a gap of what the market needs. Today, there are a lot of products in Asia. A lot of the funds are quite similar, especially in China or even India. So you have to have a very clear story about how you're differentiated compared to the rest of the pack. Either, it could be you're pure VC or you do pure control buyout in China, which is very hard to do, but there are some very successful players, that have done very successfully. So there's a way to differentiate yourself. That's basically the number 1 criteria. Number 2 is LPs today demands a lot. So basically for any sort of managers, unless you're, coming in with your 5th funds and your track record's like 5 times, basically you need co-investments to offer to LPs. Maybe for very big LPs, you give them special economics to really help them to speed up their process. That sort of things is needed. The last thing, which a lot of GPs don't recognize, and I guess this is only from a placement agent's eyes, is we need a very good presenter on your team. I don't care how good your strategy is, but if you can't present precisely what you're trying to tell people, it's not going to work. So, we have a joke internally. If there's a Harvard MBA with Goldman Sachs background, that's the successful formula for fundraising.
Yeah, I think I'll echo what Dennis just mentioned. Sitting on the LP side for the last 10 years, I can see that happening because we see a lot of GPs pretty much on a daily basis, people walking to our doors and someone or the other is raising capital. And it's very critical that in the first 5 to 10 minutes, the GP needs to present something which sparks the interest. Because otherwise, after that, it's just a blur, right? Means there are so many of GPs out there, whether it's PE, VC, you name the asset class, but we are meeting them on a daily basis. So unless there is something that catches our eye in the first 5-10 minutes, the remaining 40-50 minutes of that meeting is actually not going to help you. So I think it's very important to have a story which is clear, concise, to the point, and well presented in the first few minutes of your meeting. If you can get there, then you're gold. Otherwise, you are one of the 20 managers that I've seen in that week. So there's nothing special, and then it just becomes a uphill battle after that. So I think that's a very important point that Dennis has made. You have to be very to the point, clear, concise, and a story which resonates.
So I noticed in the LPs are on this side, and the VCPs are on this side. And yes, so for us, we are in the fundraising, and I absolutely understand the points that you're making. So one of the things that we have found in our sort of deliberations about what is the story and how do you define yourself. Right now, I'm speaking as the private equity head is we need to figure out where even in this whole continuum that we want to play. And for us, even though on the PE side we don't take technology risk, but we realize that technology actually is critical in value creation, in enterprise, and in obviously the outsized returns that LPs are looking for as to why they even invest in alternative or private market asset class. So in TBM, what we do is in the PE side, we still embrace technology, but we put it under the name of innovation. So if I was to meet both of you, I would say We are an innovation embracing private equity. And what we mean by innovation is actually the use of proven technology in either a new function, a new method, a new market, and also in a new business model. And I think this is also back to the theme of the conference, why people are now confused between VC and PE. Because a lot of the VC guys, especially the bigger Ds, they're really investing in innovation. They're not investing in technology risk. They're not particularly investing in invention. If you equate technology with invention, they are looking at business models. So if you take a Google and you bring it to become a Baidu, that to us is innovation. There's not that much technology risk in that. But yet the people who invest in it are generally termed as VCs. But that would be something that we as PEs would say, yeah, we can invest in that because it's innovation. There's not technology risk. There's no proof of concept of the technology component. But it is a business model. It is a new market. It is aggregating and bundling existing proven technology in a new application. And so I think, to Vincent's point earlier, a lot of the deals that we see in Asia are actually highly innovative, and it responds to the marketplace. And this is where we think that this is really the area that would deliver outsized returns, but with perhaps less of the risk than a traditional VC play.
I think on the top of that is, I'm a believer. I came from a growth background, but over time, I'm not a disbeliever of growth. But growth is the most challenging part to make money, which even initially I did not believe that, but over time, when some of my original LP told me, I think that was from a so-called illusion to reality. I think growth is the most difficult part, at least for the emerging market to make money. I'm a strong believer of buyout. I'm a strong believer of venture. For growth, if you do the traditional growth, I think to some extent, it's a suicide in the emerging markets. Because you're a minority, you don't have technology element, and these guys, many of them do not know about corporate governance, not because of the education where they come from. So with that, I think as a GP, there is always a demand from a company builder perspective to have, I think it's go back to the point, to do Series A is the most difficult part for venture and growth. Who has a mandate, has the time, has the knowledge and the experience to do that, both in terms of venture and growth. I think that barriers between venture and growth are diminishing because, just like I mentioned, we did the Vertis Medical, similar to like Fullerton in Great Bay Area. When we did that, it took 2 years together with a medical healthcare group. But over time, once you build that, within 9 months, GIC came in. So this is a reflection. Same for the other deals we have done. It's the same thing. It's a similar experience when you do venture. Whether it's a startup, it's a name. But we can apply to both technology and non-technology. But that is always the future to our generation and the future generation. That is always a demand on people able to understand how to do company building and able to fund it. I think that is really also a future for our next generation. Otherwise, I think everyone say there's a lot of competition. So there's no future. Actually, I'm very hopeful. There's a lot of future, but you just have to change the way. Unless you raise so much money, you can be KKR investing Gojek, which is a different story. Yeah.
Thank you. Vincent, from your earlier discussion, I gather from you that you feel, from in a China perspective, VC and PE, it's actually one and the same. But for Huixin, I can hear from your presentation that you mentioned you put on your PE hat and the VC hat at certain points. So to me, I see a very clear you distinguish the two very clearly. So my question more to Hui Xin is, do you think, along the same lines of where Vincent went earlier, that in Southeast Asia, the lines are going to be blurred within the next decade, that everyone's probably going to say it's one and the same?
I think that in Southeast Asia, most of the deals are really what I call innovation deals. And, and in this area, both VCs and PEs can play because it is not pure commercialization. There is the sexy factor of something very new, whether it's deploying technology in a different way. And you have great gaps in the marketplace. So you're filling unmet needs or underserved needs. And so the growth aspect can be tremendous in that respect. And so returns could be very much VC-like in the traditional, if you look at the longitudinal returns of VCs, whether they are 17 to 20% net IRR range. And we've seen that. In addition, when you have places where there's great gaps to invest in, we also see the ability to do greenfield or brownfield, which are very early stage, and you create basically the business because it doesn't exist. So it'll take a time before you can do aggregation, you can do buyout, etc. And so for us, so long as we're not taking the technology or the invention risk, this is what we do. In our existing 5 portfolio companies that we've done under the PE side, which is only 10 years old out of the 35 years history, 4 of them were greenfield. Do you consider them VC deals? Not really, they were services. There was no technology risk. We brought in a lot of technology, sensor, data, analytics, etc. But we didn't consider them as VC technology risk. So, and we believe, as well, I can only speak from the healthcare perspective. When we look at Southeast Asia, when we look at we did our gap analysis, we saw a lot of these opportunities where we didn't have to take technology risk. But if we built this, we might have to build it from either greenfield or brownfield. We can do some aggregation, but we will need to bundle in and integrate a lot of products and quality matrix to make it truly a scalable business model. And if you do this kind of work, you can get outsized returns. So like for us, when we did our first portfolio, it was a greenfield. We actually got a 10.9x return, which is as high as any of the VC deals that we've done on the pharma side. So yes, long answer to your question. I do think the lines are blurring. I do think that people, investors on the private market side are playing the whole spectrum. To Vincent's point, I think we need to be opportunistic. Southeast Asia is a huge marketplace of 600 to 700 million population and all kinds of wonderful economic matrix on growth, middle class, etc. But there are, I think, more opportunities to deploy capital into more innovative or market expansion kind of areas than in pure technology. You know, we're not really seeing too many new first-in-man disruptive technology platforms that's coming out of it. But nevertheless, as we know from the matrix, you know, VC tech deals take up 40+% of all deals done, whether by volume or by amount. So, and they call them VC deals, right?
Thanks, Hui Xin. Interestingly, now that you mentioned about returns, maybe I'd like to ask Amit on the returns. Amit, with your experience in AlpInvest, with respect to exit activities and return disposals. Do you have any views on whether there's correlations between the capital raise as well as return outcomes?
At Alpinvest, we haven't really invested a lot in the VC space, to be very honest. But I guess based on what I've seen in the market, I think I may have mentioned in the beginning in my intro, we do see that a lot of the return in the VC asset class is driven by a very handful of investments. I think if my stats are right, over the period of 2008 to 18, there are about 80,000 VC investments globally, of which only about 7,000 odd have been exited at returns which could be respectable. And even there, I think the returns are basically driven by like a few hundreds, leading to like 80% of the outcomes. So the return profile is very skewed. I mean, not to say that PE doesn't suffer from that sort of problem. Obviously, returns are important, but at least on the PE side, where managers have sort of more mature companies, more mature business models, more control on the destiny, there are optionalities which you can explore, which may or may not be available on the VC landscape, where you're relying on the next big capital raise or maybe an IPO eventually. So I think I won't be able to comment specifically based on Alpinvest because we haven't done a lot of VC investments. We have done a few. But based on the market stats, it seems like the returns are actually skewed by a few very big home runs, while the overall, general return profile is not that positive.
I guess I'll answer this question slightly differently, where, if we look at Asia as a whole, let's, I'll spend 1 minute going very quickly through Asia, right? Developed Asia, so Japan, Korea, Australia. I think they are more of a PE market, and their returns are very similar to what you get in US or Europe. So you would expect, 2.5 times growth, that sort of numbers. And I think the managers there are delivering that sort of numbers, right? So then you move to India. Sorry, Amit. But India is a big question mark. I don't think a lot of people, a lot of people are active there, but not a lot of people have made a lot of money. I think today, there are probably 5 good GPs in that market, but outside of those 5, is pretty wild, I would say. Then you go to Southeast Asia, and this is very interesting, because a lot of US and European LPs comes to us and say, what do you have in Southeast Asia? We do have something, but, the fact is, the returns hasn't really delivered yet. And a lot of the GPs in this region, in the PE space in particular, are having a lot of issues. They're having issues exiting companies. They're having issues of investing in companies. So both sourcing and exit is a challenge. And you have seen, I'm sure you guys know that there are a couple of restructuring of GPs happened in this region, right? And then if you move to the VC space, there are great technology, but the opportunity set for a lot of US or European LPs are just too small. So if I'm trying to raise a Southeast Asia VC funds that's 80 million in total, as a US public pension, I can't invest in it because my minimum ticket is actually more than you or higher than you. So how can I even participate in this market? So what they're left with is really China. And so, the interesting thing is when we talk about Asia, a lot of times the effort will go into about China. And China is the same issue. A lot of nice numbers on the book, but there aren't a lot of real exit. And if there are, it would be coming from those 1 or 2 big home runs that everybody knows.
Well, see, we're running a bit out of time, so I will come with a question to all the 4 panelists. How do you see, because Asia is a very up and coming and actually the biggest growth area for the next decade, how do you see legislation or regulation by the different regulators throughout Southeast Asia and even Greater China, impacting on the VC and PE market. Any thoughts?
I'll take this one first. I think there will be regulations will continue, and I think in different countries in Asia we're seeing different regulations. And if we just use healthcare, for example, in China, right? I think the Chinese government is very conscious of they need to improve the overall healthcare system. So there will be a lot of regulations to help to drive deal flows, or perhaps they ask the SOEs to be more competitive. So therefore, it allows the PE players to potentially look at deals for SOEs carve-out in China. So I think regulations can come in both sides, meaning the good side will increase deal flows, will ease the exit a little bit, but in terms of the bad side would be more stringent on what you can invest, what you can't invest. Can foreign LP comes into that particular country, foreign capital investments, etc. And I think there will be just a lot more regulations coming going forward.
I think briefly about from a GP perspective, education is art and healthcare is also been heavily affected last year. So if we go into all the details, both listed, unlisted investment in the early childhood to some of the high school, I think that was affected heavily. Share prices can drop 50% in a day for some of the listed portfolio. I think in terms of fundraising, which is not something I'm good at, even for renminbi, I was told last year, also there was if you're managing a renminbi GP, I think you are in a bit deep trouble. So that is really the reality we face in the emerging market, including China.
So extending on just commenting on the healthcare side, of course, healthcare sector is heavily regulated already because it touches all of our bodies, which is important. And so, and the big challenge there is how do you get accessibility, affordability, and better quality for the emerging middle and lower class of the population. And this is obviously politically important for social harmony, for elections, and all kinds of other impact implications. So what we have seen is that governments and regulators have been very embracing. They have tried to streamline the approval process for new products and introductions. They have introduced all kinds of schemes to enable startups, etc. In Singapore, obviously, this is not restricted to healthcare, but there's a lot of matching schemes, grant schemes, entrepreneur, support schemes, accelerators, making a comeback, used to be called incubators. And then even on the regulation of the GP side, Singapore's Monetary Authority of Singapore have introduced the VC approval process, which makes it much easier for VCs to get licensed as a fund manager. They don't need to have the minimum capital and all the other more onerous compliance regulations. So I think regulators are generally quite encouraging about technology, introduction, entrepreneurship, as well as the VC class. So I think that's all positive, and I'm only talking about Southeast Asia because China is a different ballgame. But just one comment on China from a healthcare perspective, if we look at the vertical that we're quite interested in is in fertility. And of course, when the Chinese government lifted the one-child policy, that had huge implications for the marketplace. And then after that, we also heard that they are also lifting the number of IVF licensing, which was a constraint in the industry development. And so whatever the number is, I've heard is, they're going to give 20 more licenses, etc. But that kind of thing is really important for regulated sectors like healthcare. And so far, we're seeing very positive things that's come out on that front.
Thank you very much, panelists. I think you answered everyone's questions very well. Maybe if I have to sum up, correct me if I'm wrong. For this topic, if you're looking at crystal ball, I believe summing it, there's always going to be a niche market for PE and VC. However, because of how each PE or VC look at their investment criteria, the lines may seem to be blurring. But in effect, there is still very clear lines, just not obvious to a person who is not within the industry. Am I right to say that? Thank you, everyone. Have a good afternoon.